Lead is likely to remain on a less volatile path than the rest of the base metals due to its unique characteristics, in which it has lower exposure to primary supply risks, with 2/3 of production coming from secondary sources. It also has lower exposure to primary demand risks, with its largest end use coming from the replacement of lead-acid batteries, which makes this area of demand somewhat recession-proof. And lead's overall relative illiquidity and its commonly misunderstood long-term role in decarbonisation. In our view, we expect that lead prices are likely to remain in a tight range towards year-end and into 2026, with potential upside supported by a warming in the macroeconomic outlook on lower Western interest rates and Chinese stimulus, while cold weather will increase seasonality demand for lead-acid battery replacement in the months ahead. In addition, with the lead market currently well stocked, with LME inventories well above 5-year averages, and a muted outlook from investors, especially given the possibility of lead being removed from the Bloomberg Commodity Index, a lack of price direction could result in lead taking its price cues from copper. On a medium-term basis, we see bullish price prospects as limited, with the market set to post increasing surpluses, with robust supply growth and no convincing structural bullish demand narrative. Mine production is on track to rebound in 2025 and 2026, with an acceleration in output in Europe, India and Peru, offsetting reductions in Brazil, Kazakhstan and the US. In addition, the forecast recovery in zinc mine supply over the years ahead will provide underlying support, with lead a key byproduct. In turn, we forecast that refined output will post growth of 1.7% year-on-year in 2025, reversing losses in 2024, with production growth in China over the January to July period having already more than doubled on a year-on-year basis. Despite lead's unique characteristics, with its largest end use stemming from lead-acid battery replacement, providing lead with a somewhat recession-proof characteristic, demand for new internal combustion engine vehicles has been disappointing in 2025, especially outside China, with high interest rates and building uncertainty over economic growth from trade tariffs preventing spending on big-ticket items. Meanwhile, in the US, 50% tariffs on imports of automotives and parts has increased raw material prices, hurting manufacturing. However, we expect that consumption will improve modestly in 2026 on cyclical demand recovery, alongside a slower than forecast transition to battery electric vehicles, underpinning prices.